Welcome to our first week of personal finance notes. A few introductory notes. First of all, as you know, we're going to have team tryouts for the first time this year. Everyone who tries out can be assigned to a team as long as we have the right numbers. We need to have either 3 or 4 on a team, and I'll put 4 on the top team and then 4 and then another 4, and hopefully we'll have enough to have a number of teams. All of the teams may participate in the online competition. Only one of our teams can make it to state, but of course there's no guarantee that my tryouts are going to pick the best team. So it's very possible that the second team, for example, could beat the first team. So please don't be discouraged if you don't make the top team. It's certainly still possible to compete online. State this year is going to be different, and it's described on the Moodle site. There's a link to the MCEE website where it talks about their case study approach. And we are going to, sometime in February, start working on case study practice. Possibly not until March, because I have to work that out, and I don't think they have sample ones online yet. The topic list will be on the next slide, as well as our units. And I also wanted to remind those of you who have done this before, or tell those who haven't, that we also have this resource, the Handy Personal Finance Answer Book. And I think I have 10 of those, so I would be happy to check those out to you. Just let me know if you would like to have one. They're also available at the Ramsey County Library. These are our 10 topics, and these are the topics that are actually picked by the Council for Economic Education. The online competition is actually the same nationally, so in every state people are taking the same online test. And when you take that test, you and every member of your team will need to take it within the same, I think it is like a 2-hour time frame, and you'll be supervised by me, and you will have a sort of random selection of questions on all of these topics. So we'll go through them. Well, the way I'm going to organize it is put 2 topics together each time, and our first week, this week, will be thinking economically and budgeting. So here you go, intro, econ, and budgeting. The next week will be income taxes and saving. The next week will be financial planning and investing. Then borrowing and banking. And finally, insurance will be our final week. So economic basics, the first thing you need to know that's economic related for personal finance is this concept of the economic way of thinking. So we don't emphasize this too much in macro and micro, but it's a very basic introduction to economics kind of overview, and that is that you need to understand that people choose, that choices do involve costs, and in particular, the concept of opportunity cost will be very important in personal finance, that people respond to incentives in predictable ways. So, for example, high or low interest rates will cause people to make certain decisions about whether to save or borrow. Economic systems influence choices and incentives. That's not a huge deal here. People gain when they trade, and then people's choices have consequences for the future. And obviously number 6 is a big part of personal finance, because when you do the case studies, you'll be looking at things like how are their choices affecting their retirement? How are their choices affecting their ability to send their kids to college? So I made a list of econ terms that I've seen show up on some of the personal finance tests, and I'm not going to go through all of them because I expect that you know them from economics. Opportunity cost is a hugely important term. You're going to have a lot of situations where they're going to ask you what the opportunity cost of a decision is, whether it's, if you spend now you can't save, or if you use a credit card then you're committing future earnings to paying off the credit card. So that kind of thing will come up. Cost benefit analysis also comes up a lot, looking at what something costs and what the benefit is before somebody makes a decision. So you definitely want to apply that in the case studies. TONSTAFL is just there ain't no such thing as a free lunch, and the idea that everything has costs. We'll have a whole section on income, so I'm not going to spend time on that now. You'll want to know what consumption, transfer payments, inflation, how people's income is adjusted for inflation, things like the money illusion will come up. Interest rates are going to be really important, and we'll talk about them a lot more when we talk about in our units on savings and investment. And then there's a little bit of mention sometimes about fractional reserve banking in the Fed. So you'll want to review those notes from your econ class. Okay, here's another concept that appears a lot, and this is not necessarily one that is talked about in economics class, and that is the paced decision-making model. This particularly seems to come up in Quiz Bowl, and there will still be Quiz Bowl at state. So you'll want to know what this stands for. That the paced decision-making model means that when you're going to make a decision, for example, about how to spend your money, or whether to go to college, or whether to take a job, you want to make sure that you define the problem first. Think about all the alternatives, all the possible solutions or routes that you could take. State your criteria For example, if you're deciding whether to buy a car or not, your criteria might involve things, if you're deciding, well, let's say we're deciding which car to buy, your criteria might involve things like safety ratings, or it might involve things like miles per gallon or environmental issues. So you can set your own criteria for what your decision will be. Evaluate your alternatives, so you look at each car you're considering and rate it against your criteria, and then make a decision. So what kind of decision would merit using this formal model? Obviously, any kind of major spending decision. So what house to buy, what car to buy, where to go to college, that sort of thing. You wouldn't want to use the PACE decision-making grid to decide what kind of breakfast cereal to buy, because it would be very time-consuming and you would never get anything done. Where would you consider risks? Where do risks fit into this? I would say risks are part of your criteria. So if you think that you might have a loss as a result of a particular spending decision or saving or borrowing decision, you would want to consider that as part of the criteria. Okay, so that is basically all I'm going to talk about, the economic thinking portion. So we're going to move on to the budget basics. Most of these I think are fairly common sense, but maybe not. So first of all, your income, whatever kind of income you get, is going to be based on your human capital, your productivity, the demand for your labor, which is a derived demand. And if you think about it, all those three things are factors in marginal revenue product, right? So that's really what we're talking about, but in personal finance, we don't really use that term. Your income may be impacted by things like minimum wage, by the presence of union, and of course your net income or your disposable income is also going to be a factor of taxes. One thing that personal finance experts like to talk about is stock versus flow variables. So a flow variable is one that, think of it as being in a stream, okay, like water in a tap, right? Your income flows into your household and flows out in the form of various expenses. Your net worth is going to be a stock variable because your net worth is a particular dollar figure of what you've amassed at a particular point in time. So flow variables are things where there's a source coming in and a source going out. Stock variables, obviously there's going to be a source coming in, but then it's going to basically stop. Okay, so income flows into your household. Your income is determined by things like your skills, your education, how many hours you work, and other factors. And then within your household, and we're talking after taxes, right? So we've already paid taxes. This is your disposable income. You have fixed expenses that you have to pay. For example, anything you've signed a contract for, so if you have a car payment or a house payment. You have variable expenses, like how much am I going to spend on going to movies this week? And then you have savings. And personal finance experts like to think about savings as future spending. So it's not that you're taking that money and setting it aside and never using it. It's that you're setting it aside for something bigger, hopefully better, something that you value in the future. So what happens to cash flow? Well, ideally your cash flow stays positive, right? Ideally, the income that comes into your house during the month, for example, let's say you get $2,000 in income, right? And then you have maybe $800 in fixed expenses and let's say $400 in variable expenses. And let's say you have, that'd be a lot of savings, right? $300 in savings, and now you've got $500 more to work with, right? So you could add another $500 in variable expenses, you could save more, etc. So that would be a positive budget. Sometimes that's not what happens, right? Sometimes people's expenses exceed their income. So $2,000 comes in, and they've got $1,500 in fixed expenses, and $600 in variable expenses, and they have no savings. That's a deficit. A balanced budget, of course, is when they're completely equal, and that would be including the savings. So it's not just that your income equals your expenses, but that your income equals expenses plus savings. An emergency fund, personal finance advisors suggest having at least 3 months worth of your expenses in savings in a form that's highly liquid. So if you lost your job, you'd be able to pay for all of your fixed and variable expenses before you got a new job, and you wouldn't have to do things like sell your house or sell your wedding rings. One more thing about savings. Savings can be short or long term, so you might be saving up for a new car you're going to buy next year, or you might be saving for retirement, right, which would be a long-term savings. So you really want to designate those two. Short-term savings you probably want to keep in a pretty liquid form, and long-term savings you would want to be willing to keep in a form that will earn higher interest, but you don't have access to. So the fundamental choices, the 3 fundamental choices that you have are current spending, short-term saving, and long-term saving. And of course, current spending is going to be broken into fixed and variable expenses. But keep in mind that even fixed expenses aren't fixed forever, right? They're short-term fixed. So they're things like rent. And if you sign an apartment contract, you have to pay that fixed amount of rent for as long as you've contracted for, whether it's 1 year, 2 years, 3 years. If you've got a mortgage, obviously you're much more tied into it unless you can actually sell the house. So current spending can be fixed and variable. And then you have short-term saving, which is for things that you maybe you want to take a vacation next year and you need to set aside $100 a month to prepare for that vacation. And then longer term saving we're also going to refer to as investment, and that's the sort of thing that you might do for retirement. So even though we also can break down your budget by looking at, we could consider it as spending, saving, taxes. Taxes are not a choice. So when they ask you what are the 3 fundamental budget choices, it's current spending, short-term spending, and long-term. I'm sorry, current spending, short-term saving, long-term saving. Okay, so we've already talked a little bit about flow variables, and this is going to look at what a stock variable is. A stock variable is any asset of value that you have. So when we talk about money in economics, we say, money has to have all these characteristics, and things like gold rings and houses are not money, right? But things like gold rings and houses and baseball card collections are all assets of value. So anything that you have that has value, an asset that has value, something like a house or jewelry, okay, those things are considered stock variables, and they are assets, and they are going to count positively towards your net worth. A liability is anything that you owe. So for example, a loan, a car loan, a mortgage, college loans, those kinds of things. So to calculate your net worth, it's not the same as looking at your monthly budget or your cash flow statement. Your net worth is your assets, so all of those things that you have of value. And it does in fact include, your bank savings account or a certificate of deposit or what you have in a retirement account. So the cash that you've held on to in either short or long-term savings counts as an asset. So you take your assets and then you subtract everything that you owe to other people, so the value of your mortgage and your college loans, and that's how you calculate your net worth. And of course the goal is to have a positive net worth, but it can be negative, right? You might owe more on your house and your college loans than you actually have. And there are plenty of people who seem to have lots of money and live a very grandiose lifestyle who actually have a negative net worth because they owe more than the value of what they're actually possessing. Another thing to remember is there's a difference between deficit and debt. Deficit is a flow variable, right? It refers to 1 year, 1 month, that income stream, and debt is a stock variable. It is a semi-permanent, right? Semi-permanent negative. All right, so a few questions, and then I'm going to stop and I'll record the second part of the video separately. So what is disposable income? It is your after-tax income. It also includes transfer payments. So the money, if you are, for example, a retiree, you might not actually have an income. You might not actually be earning an income from a job or contributing to GDP or national income, but because you receive transfer payments, like payments from your retirement account and your Social Security, you actually will have disposable income. What are the 3 parts of a family budget? We just talked about that, right? We have spending, we have short-term saving, long-term saving. What are fixed and variable expenses? You should be able to think of some of those, but fixed expenses are anything that is contractual, where you've actually locked yourself in and agreed to pay a certain amount, right, for a set period of time. Variable expenses are ones that can change. So how much are you spending on food? How much are you spending on entertainment? How much are you, even electricity? Even though you're paying electricity every month, it's variable because some months you use more and some months you use less. In Minnesota, you certainly would use a lot more, for example, heat in the winter, right? And you might use less in the summer. What does pay yourself first mean? It means savings comes first. So you want to set aside 15% of your income for yourself in the future, okay, rather than spending it on consumption. And what is net worth? How is it calculated? Assets minus liabilities. All right, I'm going to stop this video and I will make a second one.